about 3 months ago, not even 2 months ago, Chinese bond yields went below US Treasury yields on the 10-year and above, in the long-dated bonds for the first time since the Chinese bond market really started to open up to foreigners. So first time in the past 10 years.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with international macro expert Louis Gave. If you haven't yet watched part 1 of our discussion with Louis, in which he explains why the investing world has permanently changed now that globalization is breaking down, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. Louis also shares his outlook on which assets will perform best through the rough ride he sees ahead for the rest of this year, so be sure to stick around to the end for that. Okay, let's get started watching part 2 of our interview with Louis Gave. So in terms of, the key question that you started your answer with, which is, hey, let's not determine whether it's good or it's bad or whatever, let's just talk if there's money to be made here. As you look at it through your lens, do you see... Where do you see the biggest opportunities to generate attractive returns in this arc of these shifting trade lines here?
So, look, we're all the fruits of our own experiences, and I think my own. So I'm French originally, and we did something fairly similar in Europe in the 1970s. Europe was complaining to the US that the US was basically debasing its currency, and Treasury Secretary Connolly said, look, the US dollar is our currency and your problem. In essence, go stuff yourselves. He was too polite to say that, but that's basically what he said. And Europe's answer was to say, okay, well, if you're going to do this, then we're going to move away from the US dollar and we're going to start trading in Deutschmark. And all the trade within Europe started to move into Deutschmark.
Right. And sorry to interrupt, but at the same time you did that, you also said, okay, US, we'll call your bluff. Here are the dollars we're holding. Give us your gold.
Yeah, give us your gold. And yeah, so that was the end of the gold system. And then what ended up happening was that the interest rates, so if you go back to the late 70s, the interest rates on German bonds moved below the interest rates on US treasuries. And at the time, everybody thought, well, that makes no sense. Remember that 40 years ago, Germany, 40 years before that, Germany was, an economic ruin. Yeah. And 60 years before that, you'd had a hyperinflation. So everybody looked at this and thought, this doesn't make any sense. Why would German bond yields be below US bond yields? And they basically stayed there ever since, outside of a tiny period during the German reunification. And so the first step was German bond yields falling below US bond yields. And then the second step, as basically the Deutschmark became Europe's trading currency, is that all of the other European countries' interest rates started to veer towards, and they were sort of pulled down by the German ones. And of course, this was further promoted by the creation of the euro, etc. But, when you think of the de-dollarization of Europe, where you made the most money was in owning things like Greek debt or Italian debt that was yielding 7, 8, 9% and went down to 3%, 2%, etc. And in that wave of interest rates falling and currency rising, there was a ton of money to be made. So about 3 months ago, not even 2 months ago, Chinese bond yields went below US Treasury yields on the 10-year and above, in the long-dated bonds for the first time since the Chinese bond market really started to open up to foreigners. So first time in the past 10 years.
I'm embarrassed to admit this. I didn't notice that. That actually is crazy.
Yeah, nobody did. But today the Chinese government borrows at a lower rates than the US government. And just like Germany did. And when you tell people to your reaction, people are like, well, that's crazy. That makes no sense. And the next step, so, I think that's a structural shift. And from now on, Chinese bond yields will continue to be lower than US bond yields for as long as we can imagine. And then the next step will be that other bond yields around Asia, as the renminbi starts to replace the US dollar as Asia's trading currency, as Asia's saving currency, as Asia's funding currency. As more and more trade in Asia starts to basically, let's say the trade between China and Indonesia, or the trade between China and Thailand, or the trade between China and India. As all of this moves into renminbi rather than US dollars, the stability of these countries will be improved, and the bond yields in these various countries will go down. So today, the great opportunity, when I talk about Chinese bonds to investors, especially in the US, say, well, I can't own Chinese bonds. I don't want to fund the Chinese Communist Party. I'm a patriot, and these guys are horrible people, and I'm not going to buy Chinese government bonds. I'd say, okay, don't do that. Buy Indonesian government bonds, buy Indian government bonds, buy Malaysian government bonds. And because there, in fact, it's like owning Italian government bonds to participate in the German Bund market. Used to be. It's the same trade. You take the European playbook that worked 35 years ago, and you apply that to Asia today.
All right, that is fascinating. Excellent. Wow. Thank you for sharing that. That's great. This is exactly the kind of nuggets that we hope these discussions are going to surface here. All right, and that's a great transition into just sort of the market outlook side of this. So the people who generally watch these videos, Louis, are folks that are, have worked hard to amass wealth or trying to, and they're looking at all of these global cross currents that are going on right now. They're concerned about inflation eating into the purchasing power of their wealth. They're worried about a coming recession. You've just educated us on some of the tectonic shifts going on at the geopolitical level, the global trade levels. So they just don't want to become roadkill through all this. They're just trying to figure out, how can I kind of prudently shepherd my wealth through this, where I'm at least protecting it and maybe finding some opportunities to grow it. You just gave them one good example of an opportunity to grow. What is your general outlook here for the markets at this point in time, and other assets in addition to Asian bonds, Asian government bonds, that you think are worth considering, let's say over the next year here?
How much time do you have?
Much you got.
Because all right, I'll try to keep it short. But to every private investor out there, the first acknowledgement that you must make is that I would say, I mean, I don't know about your viewers, but I imagine a number of them would have the typical balanced portfolio, because that's what's worked for 25 years, where you had, 60 in equities and 40 in bonds, or a derivative thereof. And all of a sudden, with horror, they find over the past 12 to 18 months that it doesn't work, that the bonds are no longer diversifying their equity portfolio. And rather than reduce the volatility of the portfolio, the bonds might actually be increasing it. So, the first thing to do when things don't work is to stop doing the thing that doesn't work. And so the first point today is to acknowledge, the balanced portfolio worked for a world that no longer exists, that I'm no longer in. I used to live in a deflationary world, a disinflationary world. I no longer live in that world.
Okay. We're back to your analogy of American football, where it's time to get the other team on the field, right?
Exactly. So that's your first step. So I would say that, instead of having a 60-40 portfolio, 60 equity, 40 bonds, look at it in a different way. You probably need different pockets, and your first pocket should be, okay, in this deeply disturbed world of mine, where can I find, the first pocket should be, where can I find assets where I have intrinsic value? And here the big problem is, government bonds that give you minus 5% real have no intrinsic value. They don't. They just don't. So if you want to keep a bond component, you have to look elsewhere. Now, today you can find bonds that give you value. You can. They're broadly in emerging markets, so they come with a different risk profile, a different volatility profile. Maybe you can't have as much as you had of the same bonds, but I would say, the first things you want to consider is, you take what used to be your 40% in Western government bonds, and you start looking at emerging market bonds, and you start looking at assets that lately have been negatively correlated with all your other risk assets. And the obvious one here is energy. In an inflationary environment, energy is very volatile in itself, so it adds volatility to your portfolio, but it tends to be negatively correlated to the rest of the portfolio, because when energy prices rise, everything else gets crushed. Your equities get crushed, etc. And when energy prices roll over, then the rest can thrive in an inflationary environment. So in an inflationary environment, energy starts to matter a whole lot more. Now, there's lots of different ways to play energies. You can, our mutual friend David Hay loves to do it through MLPs, lower volatility, higher income. It's great for private wealth clients. But so you can play it through MLPs. You can play it through oil and gas names. You can, play it by buying energy directly. You can buy by buying coal miners. Lots of different ways, but you need an energy component in your portfolio. I think you need an emerging market bond component in your portfolio. And once you have these sort of bulwarks in your portfolio, then you can look for the growth opportunities that you might typically find on equities. Now, personally, when I'm looking to deploy capital, and this is my own bias, we all have our own biases, but I personally like to buy equities I like to buy undervalued. I have a big value slant. Different people have different things, but I have a value slant, and I like to buy undervalued equities in undervalued currencies. Then I get I feel like I get a twin protection. And today, you could say, well, the undervalued currencies are in Europe, which I don't want to be in for all the reasons we've already discussed. Is in Japan, so I think there's good opportunities in Japan. It's in Korea, I think there's good opportunities there. It's frankly all across Asia where currencies are quite cheap. It's in Canada where the Canadian dollar is very cheap. So I'd be more keen to deploy capital in those types of markets than the U.S. today, because the more the U.S. dollar rises, the more margins are going to come under pressure in the U.S.
All right, that was a fantastic answer. So we had realized that the 60-40 rule book that worked so well for the past couple of decades doesn't work anymore. You're going to need basically to deploy a different team on the field. Look for intrinsic value assets. The ones you like here are emerging market bonds with real yields. You sort of suggest taking, your allocation that's in the 40% of sort of traditional developed nation sovereign debt and shift it into that. Energy, real big, growth, and then probably in all these categories, but in general, look for undervalued stocks that are priced in undervalued currencies, and you gave us some great places to look there. At the very beginning, you said that this was time to get your defense on the field. What do you think right now is the role of assets like cash or precious metals? Do they play an important role given where we are right now in this bear market? You mentioned that we may be shifting from your general Ursus minor to an Ursus, I think you said Magnus type of bear market here. So anyways, cash, precious metals, sort of more safety related, defense oriented positions. What do you think?
Yeah, look, yes. And in an inflationary environment, cash becomes an asset class in its own right. And of course, so do precious metals. So no, I think that's definitely, should be a part of a portfolio. The way I think you want to conceptualize your portfolio is, so I've played a lot of rugby in my life, and I'm still very involved in rugby, and it's not that dissimilar to American football, in that in rugby, every player has a specific job. That's his job. Same in American football, right? You're not going to expect in American football, you don't expect your quarterback to be the best tackler on the team. You don't expect your offensive lineman to run the 100 meters in 10.5 seconds.
Right. He's not going to be a wide receiver. Yeah.
No. So everybody's got, different body shapes, different types, etc. And the same is true in a portfolio. You need to, and I think a lot of people forgot that in the bull market. In the bull market, a lot of people ended up, all these aggressive growth portfolios, ended up building portfolios that were basically portfolios made up of 15 Tom Brady's. Now, granted, it's awesome to have Tom Brady on your team, but if you have a team on the pitch with 15 Tom Brady's, you're going to lose, and you're going to lose badly. A portfolio is the same. You can't have 15 Tom Brady's. You can have one, but you need an offensive line. You need defensive assets. And so today people tell me, oh, but cash, the returns are disappointing. Gold, the returns are disappointing. But that's like saying your offensive lineman doesn't run the 100 meters in 10.5 seconds. That's not their job. Gold's job is to protect you when things go really badly, when you move into an Ursus Magnus. And by the way, gold has been disappointing this year for US dollar investors. It's been awesome for everybody else. It's been awesome for people in Japan and Korea and Europe. Gold is more than held up its share because in foreign currencies, in pretty much any foreign currency, gold is making all-time highs. So yes, you're coming into a bear market, and in a bear market, you want some really, really big offensive linemen. And I think, gold and cash they are offensive linemen. No, so we're not coming in. We are in a bear market. Sorry, we are in a bear market. The only question is, does it get worse, and how do we get out? Now, in my career, we've come out of bear markets when either A, the energy price collapsed, hereby freeing up a lot of excess liquidity for the market. B, when the Fed started to ease, basically re-injecting a lot of liquidity into the system. Or C, when the US dollar tanked, and hereby allowing other central banks around the world to ease. Those are the three ways out of a bear market. And right now, energy prices aren't collapsing. The Fed isn't easing, and the US dollar is not tanking. So, we are still in a bear market.
All right. Yeah. And other experts I've had on recently who have had long careers in the markets have said that almost always a true bear market ends in tears. It ends when nobody wants to touch a stock again, and they're just seeing way too much willingness right now of folks to pounce back into the market and try to catch the next upcycle here. They don't feel that they're seeing that capitulation yet, where people are just broken in terms of their attitude towards the markets. So is it fair to say then?
I think that's exactly right. I think you're still seeing people buy the NASDAQ on every dip. You're still seeing, discussions at dinner table, whether it's time to get back into Peloton or Zoom communications or, whatever, any of these, down 90% stocks. So no, we're still very much there.
All right. Well, look, Louis, I'm going to wrap it up here, but is it fair to say that you think the probability is, let's say, more likely than not that you see more continued downward action in this bear market?
I would say in Europe, yes. I think in China, actually, China sort of beats the tomb of its own drums, and its market is completely uncorrelated to others. And we've already, we're sort of a number of years into the Chinese bear market, and we're now in the phase in China where the government is already re-stimulating, unlike what we have in the Western world. In the Western world, we're facing tighter monetary and probably tighter fiscal, which is two big headwinds. In China, that's shifting. So I think in China we are moving into a bull market. In China we could be bottoming. Let me put it this way. In Europe, I don't see why we would bottom. In the US, I think it's going to depend a lot on basically the Fed over the coming quarters. I think that the general perception out there is the Fed continues to tighten, and if it does, it's hard to see why the markets would rally on that. If the Fed starts to shift its message, but it's hard for the Fed to shift its message given the underlying inflation rate. But if the Fed starts to shift its message, then we could bottom. But I think for now, you have to assume that the Fed stays tighter and the markets struggle.
All right. So keep your defensive team with its beefy defensive linemen on the field here.
Absolutely.
All right. Well, look, Louis, for folks that have really enjoyed getting to know you through this interview, where can they go to learn more about you and follow your work?
Well, thank you very much for having me. The easiest, I'm not really on social media. So the easiest is just to go to our website, actually. So it's gavekal.com. So it's GAVEKAL.com. That's for, all of our published research, and we have like different products that we publish at different price points, etc. Although what we tend to do is very institutional. And then for more retail investors, I would point them towards Evergreen GavCal, where we have a free newsletter. And Evergreen GavCal is the business run by my colleague David Hay, which is our private wealth business.
Great, great. And David has a great Substack too that's available for free that folks can read too. All right. Well, look, Louis, when
that
we
folks should definitely sign up for.
They definitely should. So I'll put up the URL for that as well as for gavcal.com on the screen when we edit this process, so folks will clearly know where to go. Louis, it's just been a total pleasure. Thanks so much for giving us so much time. Really enjoyed this discussion. Look forward to having you back on again the program soon.
Whenever you want. Thanks a bunch.
Well, all right. Now's the time on the program where we bring in the lead partners from New Harbor Financial to do a little reaction to what Louis Gav just said there. New Harbor Financial is one of the financial advisory firms officially endorsed by Wealthion. And this week, I'm joined as usual by lead partners Mike Preston and John Loderer. Hey guys, Mike, why don't we start with you? What was your reaction to what Louis said here?
Hey, Adam, good to be back. Let's see, we're recording this on July 27th. It's Fed Day. And Louis said that we were in a bear market, plain and simple. You asked him what he thought was happening right now. And he says, we're in a bear market and probably will remain there. We had a huge rally today after the Fed. They hiked 0.75%, 75 basis points as expected, but still the NASDAQ was up almost 5%. But with that move, the S&P is down 16.5% from the all-time high. It's not bear market territory anymore, but it did touch a little more than 20%. And, Louis talked about how, bear market is just defined by, a 20% drop. It's usually the definition. And a run-of-the-mill bear market would be a 20% drop. But, the next 20% in some deeper bear markets, happens after things don't get better quickly and as other information comes to light. And, seeing that we've had the largest, parabolic blow off top, I think in U.S. history, probably in a lot of ways, even more than 1929 timeframe, that it's hard to believe that this is just going to be a run of the mill bear market, particularly when valuations are just still sky high. And you can see in the tape, you can see in the market that really everyone is just wanting to buy every single turn. And the resilience is just really remarkable. And so I know that there's a number of indicators out there that point towards too much pessimism, opinions of individual investors and things like that. But if you look at what people are actually doing, they're not selling stocks, they're buying quickly and, with bated breath. And the actual allocations to equities are up in the 65, 66 percentile, something like that, and barely off the all-time high. So what people are actually doing with their money does not seem to me like there's too much pessimism. There's just a couple other things Louis mentioned that I think I'd point out there. He says, that it might be different this time and that there's been so much stimulus in the system that asset prices are way up even now, that this is likely to be greater than your run of the mill bear market. And another thing I guess I'd touch on before I stop is he talked about China's relationship with Russia and, how post 2016 we entered into a financial warfare with Russia. And, that kind of basically strengthened the relationship in a way with China and Russia. And China really has a weakness in that they don't have a lot of commodities and Russia does. And now we see that China and Russia are a lot tighter. And the commodity shortages are only going to get worse from here, partly because of that, partly because a lot of commodities or many commodities come from emerging market countries that will almost certainly use that status as leverage potentially against us. And a lot of different reasons why commodities are going to be a problem going forward. We think that's going to be a trend that stays and we're going to see shortages, but commodities should be a good place to invest. So I'll stop there and before we get into his recommendations, but he had some very good recommendations too.
All right, John, I'm coming to you to let you give your, anything you want to add on top of what Mike just said there. And we'll come back in terms of what Louis said about, the investment opportunities he sees. He obviously likes the energy side of commodities, Mike, but he also really likes the debt of emerging markets countries that are resource rich. So I definitely want to hear your thoughts on that when we come back to you. All right, so as you said, Mike, too, today is the day that the Fed came out and gave their monthly update. I want to dig into that really deeply with you guys in just a moment here. But John, as we come back to you, Mike was saying that Louis and Mike himself think that, hey, we may not be out of the woods in terms of this bear market, even though the markets have been strengthening here of late. And I just want to revisit this checklist that Louis said. He said, hey, there's several paths out of a bear market, and the ones that he said are the typical paths are energy prices collapse, the central banks aggressively stimulate, the US dollar tanks, or investors capitulate and they don't even want to touch stocks anymore. And I think if you look at every one of those four, we don't have any of them today. So if that's really the true checklist for determining when a bear market is near its end, it doesn't seem like we're anywhere close to the end of this bear market. So anyways, let me hand the mic to you.
Yeah, that's right. I would add to that list that valuations tend to start to matter when a bear market is combined with a recession. And usually valuations get somewhere back down, certainly well below current levels, as Mike already alluded to, even with this kind of recent bear market and now coming slightly out of that bear market metric of 20% down. We're still at the single most overvalued points in history, rivaling 1929 and 2000. Think about 1982 for a moment, when it was really the start of the 20-year bull market that led to the tech bubble. The Shiller cyclically adjusted PE ratio was down around 6, I believe, versus I think it's up near 28, 30 today. Point being is that we're probably 2 or 3 times, if not more, overvalued from where, and we need not, and nor do we expect, frankly, that we're going to get down to valuations like we saw in 82. But even the 2009 market low in the housing bubble, which you might say was artificially interrupted by the monetary policies, in other words, it had further likely to go, it probably 50-60% down from here, not in a straight line, of course, but valuations tend to be the ultimate arbiter of real bear markets, at least secular bear markets, if that's what we're in. And we think this is a good case that we likely are in, with 40 years of disinflation and interest rate declines, likely at a pivot point. We need to zoom out to really see the cycle that we quite possibly are in. But speaking quickly about the Fed, one of the factors he talks to there about is the Fed easing. There's been so much talk lately, and certainly the news media loves the headline, will the Fed pivot, right? Meaning, will they stop raising interest rates, stop talking tough on inflation, and start to go back to administering morphine, lower rates, pump more liquidity in the market. The market and people have been so conditioned to that over the last decade that, the psychology of markets are thirsting for, when are we gonna get that back? When are we gonna get that back, right? That's all the headlines have been. And interestingly, the Fed today did raise the expected 75 basis points. They did speak to some signs of slowing and spending and things like that. But failed to say the word recession. In fact, pointed to employment markets as being strong. Of course, any good economist knows that employment is one of the laggiest of indicators. It's one of the last things to go in an economic cycle. In fact, there's not a single instance where employment topped in anything other than after a recession has started. So it's quite odd that the head of our central bank would raise the employment picture as the sign that the economy is strong, because that's the laggiest of all indicators. And we've seen examples, large tech companies, for example, that have been powering this market higher, have announced hiring freezes. I've got personal friends in the sector. talking about their companies these are strong, big companies, hiring freezes. We're seeing consumer warnings by the likes of Walmart, and then just after the bell today, Best Buy. These are all signs that speak to a really potentially significant slowdown in the economy, and employment is absolutely the last indicator to go. So I think the fact that the Fed raised rates even while acknowledging some slowdown kind of says something about their worries about inflation. And I agree with Lewis, and I think it might have been his colleague David Hay that talked about, or somewhat one of your recent guests, that this likelihood that inflation's suddenly magically going to go down to the magical 2% is probably not at all very likely. In fact, it flies in the face of history, where once inflation does become a problem, it sticks around for us. The pig through the python thing, and you can't just flip the switch and flush it out. And I think Lewis spoke to that again, and I think we got a long road ahead of us here, and we still think the defensive side of the equation is likely to be the bias here, even if we get some vicious rallies in the short term. I'll just make one last point. It's not uncommon on Fed days like today for the market to rally really strong and then very quickly repeal all that and then a whole lot more. We'll see what happens in the coming days, but that would not at all surprise us with the history that we can look to.
All right, yeah, this might be the sugar high of the moment, and tomorrow might tell a different story. All right, so and when this video is out, we'll know for sure, because this video is going to come out in about 2 days from the day we're recording it. All right, so a number of things you said are worth mentioning, John. One is you used the word defensive position being prudent right now, and Louis completely agrees with that. He made the whole analogy of the football teams and saying, look, different moments you need different teams on the field, and this is the time to have your defensive team on the field. And we've talked in the past about how bear markets tend to have really violent bear market rallies within them, and that some of the biggest short-term rallies in history happened on the downward slope of a secular bear market. And we may be in the process of sort of seeing one go on here. Since the last FOMC statement a month ago, we've seen the biggest combined stock and bond rally in more than 2 decades. So, already the markets have picked themselves off the lows and are beginning to act with more optimism than we've seen for most of the year. And what's interesting is, as forecast by the markets, rate hike expectations are actually coming down, and rate cut expectations are soaring. The market's now pricing in almost 5 rate cuts over the next year and a half. So I'm taking this data all from a recent Zero Hedge article, which states that if you look at the dot plot that the Fed puts out versus the market's rate cut projections, the market is now dramatically more dovish than the Fed's latest dot plot. So you've basically got the market listening to the Fed and saying, we don't believe you. We actually think you guys are going to pivot, relatively soon here, and then, start aggressively cutting, going back to easing and cutting. So it does seem to be at this point increasingly sort of a game of chicken between Powell and between the markets. And as you said, Powell basically is saying, look, I'm not changing my tune. We're still really concerned about inflation. I think he keeps hammering the strength of the jobs market to sort of say in an indirect way, I'm gonna let our jobs mandate, our mandate for full employment, I'm gonna let that slip in order to get demand down and hopefully inflation down along the way. I think that's sort of like I said, sort of a veiled way of saying, I know I've got these 2 mandates, but I'm going to throw this one under the bus to try to fulfill this one. So we'll see what happens. What was interesting too is he said that that they are going to now start kind of giving guidance on a month-by-month basis, looking at the data and then determining what they're going to do next, versus the sort of longer arc of rate hikes that they projected at the beginning of the year. Some people are taking that, it's interesting, some people are taking that as a dovish development, some are taking it as a hawkish development, but it does look like the Fed is kind of getting tired of being held to what it has told the market and is now going to hold its cards a little bit closer to its vests. So anyways, to the spirit of my original question here, John, do you think, given the direction since the last FOMC meeting and kind of the sugar high we're seeing today, could we be seeing the setup for a short-term rally? But when you think that might be, if it does happen, a good opportunity to sort of, sell the rips and not get caught up in the enthusiasm and start pushing your chips into on the long side?
Yeah, it's absolutely a possibility, Adam. We've seen a rally in recent days and weeks. For the last week or so, I've been trading over the 50-day moving average of the S&P, and that's a technically short-term bullish thing if you want to put your focus on one factor. But today's move higher was very, very strong. Again, not uncommon on Fed days. I think the coming days will become really important to see what the market makes of that. It's hard with a straight face to say the market signal coming out of any Fed day is anything but just chaos. Right? It's hard to draw any kind of logical things out of market action on a Fed day. I believe that the two-year, 10-year Treasury spread has got even more inverted today, even after the news. I may be wrong on that, but I think it's the most inverted, meaning the 10-year yield, Treasury yield, is lower than the 2-year. That is classic, at least in the world that we used to know, classic recessionary kind of indicator. But with the Fed so deeply involved in bond markets, it's hard to not question whether that's as true a read as it once was. But typically that's a pretty powerful recessionary type concern, and if that speaks to and plays out, then it becomes this really a fundamental question of how real is the Fed in its resolve to fight inflation. The early 70s saw a Fed that failed. They hiked into a recession, but ultimately failed. They cowered and let the market guide them. And it wasn't until Volcker in the early 80s had come with a bazooka to really whip inflation in the behind, excuse my French. But it was hugely unpopular from a political standpoint. Nothing this Fed is doing today is even approaching the courage and the unpopular degree of policy spine that Volcker did back then. We got a long way to go. In other words, we got a Fed that's got a lot of hiking to do to approach that kind of courage that Volcker had in the early 80s to truly whip inflation. So the question becomes, does a recession spook the Fed and they say, forget this inflation battle. We're gonna worry about, all those other things that are in large part artificial, the jobs that have, been built on stimulus and things like that. I think we got a really chaotic road ahead, and yeah, absolutely, there's the potential for a market to levitate higher from here, but durability of that we think is highly suspect for all the reasons we've talked about today and in prior weeks.
Okay, all right, great answer, Mike. I'm coming to you. John, it's interesting, or John and Mike, it's interesting that Powell basically said, hey, I don't think the economy's in recession. He mentioned the strong jobs data, and you pointed out why that actually is really a poor defense of that opinion. Look, the Fed chair is going to be the last guy to tell you he thinks we're going into a recession, because he doesn't want to spook people and kind of make it a fulfilling prophecy. But what's interesting is he's certainly denying it. President Biden just recently came out and said, I don't think we're going to go into recession, which I'm really flummoxed why you would make that comment. There's very little upside to making that comment. There's a lot of downside to making that comment if you're proven wrong, which I think you guys and I think that there's a whole preponderance of evidence to suggest that we may already be in recession, or we're certainly highly likely going to be in one going forward. And what's interesting is we just had Louis on this program, and we had Steve Hankey on the program, economist Steve Hankey, a few weeks back, and they both think that there is still enough stimulus pig left in the python of the economy going through, that we're probably not going to plunge into a deep recession tomorrow. They think that it needs to play out more. So they're saying, hey, look, we actually recession might not arrive in full force this year, as that pig is still making its way out of the python, but both of them are still very concerned about the potential for the bear market to go lower, right? So even though they think there's still some stimulus sloshing around that's going to keep the economy somewhat artificially elevated for a bit longer, they're both still kind of pessimistic when it comes to the market. So Mike, I want to go with you about, Louis' strong, counsel to, hey, get defensive, get into assets that are, going to be the right ones for this new sort of secular inflationary regime that we're going to be in going forward now that globalization has ended. So we talked very briefly about the emerging markets debts. And one of the things that Louis said that I'd love to get your thoughts on is he said, hey, a 60-40 portfolio worked great for the secular disinflationary period that we've been in for the past 40 years as we've globalized. But now that globalization is going into reverse, those bonds aren't working for you, particularly that 40% bonds aren't working for you, particularly in an environment where inflation's so high that your real yield on the bonds is negative. So he said, focus on assets that have intrinsic value, and a negative real yielding bond doesn't have intrinsic value. So you got to go elsewhere. So that's one of the reasons why he liked the emerging market debt that is delivering a real yield and is based in commodities, as you said. He also really likes energy in that space. So beyond that, and his other comments about equities and cash and whatnot, I'm just curious what you thought about Louis' recommended allocation there.
Well, Adam, I think you did a really good recap, and you covered both of his, most of his recommendations, and they pretty much parallel how we see things too. I found it interesting that he likes emerging market debt, and as you said, we talked about during this show that commodities should really be strong over the next decade or more, and the countries that produce the commodities should be a good place to invest, both in their equities and in their debt. And I know a lot of people are really concerned about emerging markets and the fact that they have themselves a lot of debt that's denominated in US dollars. And as the dollar gets stronger, it's hard on them. That's true. But a lot of that's priced in probably. And I think what we're underappreciating is how much these countries will benefit from what is likely to be a commodities bull market and a continued supply shortage. So we can't profess to be experts in emerging market debt. We're not, but the theory and the theory and the thinking seems very reasonable to us. And there's some exchange traded funds out there that you can use to invest in emerging market debt. Not a recommendation. I'm just saying, be open-minded and perhaps do some more research on it. Certainly something that we will look into as time goes by. You're right. He said the defensive team is on the field because we're in a bear market. So no more 60-40 because bonds are not a safe haven. He likes things that have intrinsic value. He said undervalued stocks, particularly energy. And we have to agree, energy should be a good place to invest. We have been invested there. We're out of the sector right now. We're looking to probably get back into it at some point in the near future, but not just energy, all commodities. But the truth is that out of the whole commodity index, energy is about 60% of it. So it's really hard to get away from that sector. A lot of your viewers might have seen natural gas go vertical recently. I think it went from something like, I could pull up a chart, but it went from something like 6 to 10 the other day, which is crazy. Yeah, it went from 6 to 10 per million cubic feet, I think it is.
Yeah, and sorry to interrupt, but that's just a great proof point to what Louis said, which is that the geopolitical chessboard now actually matters a lot more than it has in the past. He said it used to kind of fade the headlines pretty quickly. They'd grab attention, but they didn't really have much long-lasting impact. He said it's totally different now in this world where things have gotten really serious on the trade route, and that specific spike in gas prices, and you're probably looking at the price of gas here in the US, but is reacting to a massive increase in the price of gas in Europe because of the continued kind of what do you want to call it, game of chicken, I guess, that Russia and Germany are playing over shipping gas to Germany, and this whole tug of war that's going on with this turbine that Russia says it needs to be able to get the gas flowing again, but Germany's had a tough time getting it to Russia because it would be violating the embargo that the West has in place with Russia. So suddenly, these geopolitical factors matter a whole lot more, and they can do things like you just said, like increase the price of a key commodity by 50% or more almost overnight.
6 to 10 in a matter of days, and it's pulled back to 8, which is pretty crazy. But this is going to be the name of the game, we think, for the next bunch of years. This isn't going away. And like Louis said, we drove Russia right into China's arms, with the financial warfare that we had going on. So, the stakes are high, but intrinsic value assets. And he said the big offensive lineman, in your investment lineup should be precious metals and cash. And we agree, precious metals being in the commodity complex, representing real money, and cash for opportunities that are almost certainly going to come. So, yeah, no more 60-40, cash, precious metals, invest in intrinsic value assets like energy and other commodity type stuff. And do it tactically. You don't have to do it all here. We likely are going to see better prices ahead, probably even for the commodity complex. If the S&P drops, like we think it will over this coming bear market, it's presently at around 4,000. I wouldn't be surprised to see it go below 2,000 by the time it's all over, even if it goes higher first. You're probably going to be able to pick up some of these value stocks less expensively than today. So, take your time, pick away at them slowly to, and don't be afraid of missing out. There's probably going to be lots of opportunity in the year or more ahead.
All right, great. Well said. Well, look, I've actually got a new free resource to offer to Wealthion viewers here. Before I let them know what it is and wrap this up, John, I want to give you the last word here. We talk about this being a market that really is keeping everybody on their toes. Do you have any sort of parting counsel here for the regular person that's just trying to navigate all these swirling changes going on?
Only just to bring it back to their own situation. And a couple of things. Folks who have worked hard to build a very sound financial footing. There is this notion that one of the worst things you can do is, excuse my harsh language, screw that up by taking more risk than you really need to. And sometimes it's just a matter of, going through the emotion, the actions of working with an advisor like us, or talking to someone, or getting advice. Do you have enough? Do you really need to be, taking risk like you're still trying to grow your assets for 40 years down the road, or can you afford to play it safe? Ironically, even those folks that need the returns, like they haven't built that financial footing yet, one of the worst things they can do is take massive amounts of risk when the markets are as overvalued as they are remaining, because the markets don't care, right? The markets don't care what you need for returns. And all to say, to bring it back full circle, is, get in touch with where you are in your financial life, your goals. A good financial advisor can help do that. As much as we here at New Harbor immerse ourselves in the markets and data and investing and tactical investing, we do a ton with our clients in financial planning, helping it bring it all back to their situation and what makes sense for them. And just to kind of know that there is no free lunch, no matter what, right? There's always risk and reward, and really, taking stock of where we likely are in that equation. Even if we do have moves higher here, what is the potential downside with those moves, and how temporary or permanent might those moves higher be? We think those moves are likely going to be largely temporary and to a big degree. So that's, I guess, the last parting words I would say.
All right. Well, look, to your point there about the importance of the financial planning and really clarifying your goals and making sure that your portfolio is structured to be optimized for that in particular. I think Louis said something really important, which is, with the end of globalization, we really are at the dawn, or in his perspective, we're at the dawn of a new era, right? Where we've most investors watching this for their adult investing lives, there's been one playbook, and it's been the disinflation playbook as nurtured or made enabled by globalization. If globalization really is over and we're becoming a much more fractured, global society, that is by its nature, as Louis described, inflationary. And so we're looking at a secular inflationary regime ahead of us. And so the playbook that worked in the past is highly likely not to be the appropriate playbook going forward. So if you haven't yet, you really need to sit down with your advisor and say, okay, hey, how are you changing your portfolio strategy based upon this new era? And I can tell you, the vast majority of your regular kind of garden of the mill stockbroker or whatnot, they don't even think about this stuff. So they're probably going to not even understand the question very much. But if you've got a good one, send them this video, have them watch it, ask them to sit down and explain to you how you're well positioned for the type of environment that Louis just mentioned here. But if you don't have a good one, or you'd like the second opinion from a good one that does understand all of these issues, maybe even Mike and John and their firm itself, then schedule a free consultation with one of the endorsed financial advisors by Wealthion. It doesn't cost you anything. You don't have to work with these guys. They just offer it as a public service. If you want to learn more about that, stick around to the end of the video. It's coming up in a few seconds. We tell you how to set up one of those consultations. It takes just a couple of seconds to do. All right, so now to the fun part. So something that I've been considering doing for a while, and I've just actually taken folks' temperature on it, and there seems to be a strong amount of interest for this, is, these videos that we do, multiple videos every week, there's a lot of insight packed into them. And I know a lot of you are furiously scribbling notes as you're listening, and sometimes it's hard to catch everything while you're writing notes. I know many of you just want to be able to listen and soak in the conversation without having to worry about all the note taking. So just like there are cliff notes out there, you may remember from high school where you'd get the cliff notes to the novel that you guys, the big thick novel you were supposed to read in English class or whatever, and it would sort of just give you the key elements of what was, what the novel was or what the subject was. I have been toying with the idea of creating a version of that for these Wealthion videos. Lack of a better term, we'll call them Adam's notes. But these are basically my key takeaways from each interview, because I do so many of these. It's not an exhaustive list of everything, every single thing that was talked about, but it's the big notable points that stood out for me, given that I have these conversations day after day after day. And so if you'd like to be able to get access to those notes, I'm going to make them free going forward. If folks like this, I've done it for this interview with Louis Gove. And so if you want to go get those notes, you can go get them for free right now, just by going to wealthion.com/AdamsNotes. And if the feedback on them is positive, I'll keep doing them for the major interviews I do going forward. So hopefully folks like that. Again, hopefully going forward, it lets you just kind of lean back and enjoy the discussion without having to do all the furious note taking, unless you want to do it, of course. All right, folks. Well, with that said, if you like that idea, and if you enjoyed this video with Louis, if you'd like to see more continued guests of his caliber come back on the program, please just support this channel by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. John and Mike, guys, thanks so much for joining me for yet another week of making sense of these markets. Whatever happens from here, who knows, but we can guarantee that we'll be breaking it down for folks next week on this channel. Everybody else, thanks so much for watching.
Thank you, Adam. Great to be here again.
Had a great time, as usual, Adam. Thank you.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold,
And when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market will always take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.